This is the statement of shareholder equity. I think we've seen this kind of a couple times in the class, but just to revisit, now that you've spent a little more time with the equity section of the balance sheet. Again, this is a separate financial statement than the balance sheet. Okay, the balance sheet only is going to really have these totals: this total equity, retained earnings, additional paid in capital. These totals will be on the balance sheet, but now you can see how they've changed over time. So you can see this is the balance as of the last year, and then this is the current balance sheet. So you can see the change in each of these account balances, and that's why this statement is useful. So we know this one, right? The statement of retained earnings we've seen, but of course, retained earnings is only one part of the total equity. So you can see here, just from the way we've learned it, we have starting balance plus net income, right? This is the net income being added minus dividends, which is here. They're also putting in treasury stock, okay? This negative number is a debit balance. That was as we saw with treasury stock transactions. So they're rolling treasury stock into retained earnings. It's included in that number. Okay, is everyone seeing this? You have cash dividends, which is this 1.7 billion, and then they bought back stock 653 million. Okay, and these are both reductions in retained earnings. Okay, so but you can see here they earned quite a bit. This is Costco. Okay, so their retained earnings still went up because they're still reinvesting in the business. You can think about it like that. These two, dividends and cash, treasury stock transactions, are ways the company returns profit back to shareholders, but you can see that they're not returning all of it. They're still earning much more than they're returning back to shareholders. That's why retained earnings went up. Uh, in this one, there's something interesting here. This stock-based compensation. Okay, what this is basically this journal entry: salary and wage expense, debit, and instead of crediting cash, they're giving their employees stock options or stock in the company. Okay, so you can think of this is like the earnings. This is the value of the labor that the employee has given. Instead of paying them with cash, the company has compensated them with stock. And so this is the value that the employee has paid into the company, right? They've contributed their labor worth 778 million, and in compensation for that, they're getting stock in the company. So that's why this is an increase in additional paid in capital, because the employee is contributing their labor. Just like an investor is contributing cash, which has a value, the workers are contributing their labor and they're getting compensated in stock for that. Accumulated other comprehensive income. This is things from, like, okay, you can see it's actually written here. Foreign currency. So Costco has stores in Mexico, stores in the UK. When I was at my cousin's wedding in London, they had like Kirkland water there. So, all these, Costco's generating revenue in a bunch of different currencies. So you can see here that there is some foreign currency adjustment. So it must be that these other currencies appreciated against the dollar. So that's why this is a positive adjustment. So you can see, all these different elements are kind of factored into the equity. Okay. And in the end, you'll see this total. This is what's going to be on the balance sheet. And it's going to be, again, you're just going to see really this, um, this, this. You'll see all these totals. You're not going to see the changes. You need this separate statement of equity to see what's changed. Of course, you'll see this. This is going to be on the income statement, but now you're seeing how it factors into the change in equity over the period. This is, I'd say, maybe the most complicated transaction, like, statement, and really maybe the most important. The income statement is also important. You can see that quite a bit of the change is from the net income. But what's going on with these? Like this one, stock-based compensation, these two are related. Now, the details of how all this happens, I'm actually learning this too. This is a kind of complicated because the company pays for the tax uh, kind of if you as an employee get stock, there's a tax from that, like an income tax, you can say. So the company is fronting that money. So there's actually a lot of detail in stock-based compensation. This is a topic I'm learning about myself. I don't know everything. Okay. But it is now companies pay their workers a lot, especially tech workers, in stock-based compensation. So knowing the true effects on the balance sheet from that, it's important. And, so I think if you're going to pursue accounting, you should have this kind of like always learning mindset because things change. If you look at a company's balance sheet from 50 years ago, stock-based compensation was like not a thing, but now it is in the last 20, 30 years. This is just Apple's. This is a different format of how they do it. Um, they again just take the total shareholder equity from the last period, and they're kind of okay. So they're taking beginning balance. They're showing how many shares were issued. So they're kind of doing it by first paid in capital, and then they're doing it by uh, retained earnings. But believe it or not, Apple has like accumulated deficit. They have negative retained earnings. Okay. So why? I don't know. We'd have to look at the history. It did almost go bankrupt at some point. But it's been so profitable, so I'm not sure why that is. Yeah, okay, this is why. Though they're very profitable, they do a ton of stock buybacks. Okay, so you can see here that though they're generating 112 billion in profit, they're buying back 90 billion worth of stock. Okay, so they're returning most of their profit back to the shareholders. So, okay, and yeah, actually, yeah, and they are doing because you can compare these two and see that yes, actually, they're how much stock they're giving to their employees is less than what they're buying back, the value of it. Okay, so they are net giving money back to the shareholders, the actual financial investors. So this is just another format. I just wanted to show you this is like a different it's this same statement but just presented a little differently. Okay. But it's basically doing this. It's going from beginning balance of equity to ending balance of equity. Just like this is going from beginning balance of equity to ending balance are actually here. So yeah, I mean, this again, why the balance sheet is a little misleading. Because if you just looked at retained earnings, you'd see a negative number and you'd be like, oh, is Apple just never been profitable? That's totally untrue, right? They're extremely profitable, but they just return most of that profit back to their shareholders. Okay, so this is why understanding financial statements and how all this stuff fits together is important because you need to, as an analyst, you need to understand this, right? If you just knew, oh, retained earnings is like the lifetime earnings of the business and you saw Apple had a negative number, you could come to the wrong conclusion that it's just not a profitable business, but that's not true. Another topic that they talk about in the chapter is prior period adjustments. And so if you changed, so this is Tesla. Um, this adjustment that they made, it basically allowed Tesla to pull forward revenue that it was previous. So there's some change in the accounting standard where basically Tesla before in the old standard had recorded cash that it received as unearned revenue as a liability. But the change in this accounting standard is now allowing them to just recognize all the revenue up front. And this is for um, sales with buyback options. Okay, so for whatever reason, the standards for how to account for this changed. And it sounds like it's more aggressive, like to allow a company that is first booking unearned revenue and has to recognize revenue over time to now just let them recognize all of it as revenue up front. We'd have to look into the details. I don't know the details of ASC 606. That's the accounting rule. But for whatever reason, they were allowed to basically pull forward $623 million of profit. Okay. And so that's what this accounting change is doing. Well, actually offset by this. So around $500 million they were able to recognize. Okay. You can still see that Tesla has been, in general, has had more net losses over time than, um, as you can see, I don't think they pay a dividend or buy back stock. They don't do either one. They just have lost a lot of money historically. Okay. Um, but yeah, the point is that when you have some accounting change that's retroactive, they will just do like a net adjustment. You can see here, this is the net of revenues minus expenses. Okay, they're giving you the change in profit from this change in the accounting rules. Okay, and so this could be, this might be based on estimates. How they got this number, we'd have to dig into more detail, and maybe we wouldn't know enough from just the disclosures. Okay, so you're kind of trusting the accountants and the auditors to make sure that this number is correct. Okay. But in general, these prior period adjustments are just going to be shown on this statement of equity, basically.